What's up, everybody? Welcome back to KT Confidential. This is episode 238. Today, we're discussing Ourboro, the co-investment company that buys a share in your home's future equity by contributing to the down payment. Is it a good idea? Should you do it? You'll find out.
Here we go.
See, this music intro thing just messes with me so much.
You don't like a little pump up music to get you going?
Sure, but then it just cuts off and just dies.
Yeah, and you're supposed to get right into...
My excitement dies with it.
Yeah, well...
Are we good to go?
Yeah, we're...
Cool.
We've already started. You want to make some more adjustments there? All right.
No, I'm good to go. So today we're talking about Ourboro.
Talk about co-ownership.
So, Ourboro is a new, I don't know how old they are actually, but it's a company that seems to be gaining some steam lately and some press, and a lot of people are talking about it. So today we're going to talk about our opinion of it.
I read something that their applications are up like 400 to 500% year over year.
Well, I don't know if they existed last year or not. And
last year we had one.
Explain it.
This year we have 5.
Yeah, it's all relative. So first we'll kind of get into just explaining what they are, and then we'll talk about our thoughts on them. I don't know what your thoughts are on them. We haven't even discussed this, so it should be interesting. But Ourboro is basically, here, the first line on their website explains it. They are a co-investor who purchases a share in the future value of your home. So they are contributing a percentage of the down payment to help homeowners or help people become homeowners when they're lacking the sufficient down payment to buy a house, which is a problem.
Yeah, so they're not a lender per se. It's kind of like going to...
Or you could say they are a lender with the highest possible interest rate ever.
If you do the math, that would probably be accurate. You are likely paying more than credit card rates to get this money. But, if you don't have the option of going to the bank of mom and dad, or you don't have a friend or a relative with deep pockets willing to, lend you that money at either zero interest or a nominal fee, if you don't have those options, which, by the way, a lot of 20-somethings and 30-somethings now are being gifted money.
Early inheritance, stuff like that.
From the boomer generation that has experienced equity in their homes. And they are gifting some money to those children and grandchildren to be able to afford to buy the home. But if you don't have that option, if that is not an option for you for whatever reason, it's not available, you don't want to ask, you don't want anybody else involved, well, here is a company that as long as you have a 5% down payment, they will basically buy a part of the house with you.
Right. So they will contribute 5% to 15% of the down payment, topping it up to a total of 20%.
Yes.
Up to a maximum of $250,000.
Yes.
And whatever percentage of the down payment they contribute is the portion, or is their proportionate ownership in the equity when you sell.
Correct.
So if you have contribute, let's say you buy $1 million home, you need $200,000 down. You contribute 50. They contribute 150. They own 75% of that equity in the future.
Correct.
And
now
that's
what was unclear to me,
right,
is what is that equity calculated on?
It's appreciation. So
if
any
you buy for $1 million,
you've bought down, you get that back. Any principal you pay down, you get it back.
Yes.
It's strictly appreciation over the $1 million.
So let's say that home sells for $1.5 million.
Mm-hmm.
is the equity then 500,000, or is it 500,000 less the expenses of selling? And where does land transfer tax come into play?
So from everything I've read, it would be $500,000. With the exception of, there is one area on their website where they talk about programs where they will contribute, or they will reimburse you money for things you've done to the house that may have increased the value.
Right.
So if they see you spend,
but there's no mention on their website of land transfer tax or real estate fees or lawyer fees.
According to everything I've read, those are not considerations for this. So those are just costs of doing
maybe
business.
one of their representatives end up watching or listening to this podcast and will leave a comment and clarify for us. But
yes. Well,
so using that example, if it sells for $1,500,000 and there's $500,000 equity, so you're saying 75% of that equity is owned by this co-owner, in this case, Ourboro.
Correct.
That's a lot of bread.
It is.
So they put in 150, and my dumb math says that's equity of 375,000. Is that right?
It's about right. So you get $125,000 for yourself. The problem with it I see is that when it comes time to sell, you're going to have to move to Costa Rica because you're not going to be able to buy back into the market unless you want to significantly downgrade.
So in this case, Ourboro is getting a check for $525,000 on their initial $150,000 investment. If the home sells for $1.5 million.
They would get their down payment back plus their proportionate share of the new equity.
Right. Now, what happens if you never sell?
So there's a bit of contradicting information on their website. So it says in one area, and someone else has said this to me, that you have to sell within 10 years. But there is another, or buy them out. But there's another section that says it's actually up to 30 years, but they recommend doing buying them out or selling at 10 years because they say that way Ourboro is not cashing in on decades of your hard-earned equity.
This company is an Ontario-based company. They're based out of Toronto, from what I understand. So they are banking. They're actually putting a spin on the government program that was announced a few years ago. But they are basically saying...
I never heard anything of that, by the way, after they announced it.
Yeah, nobody's...
It would be interesting to know how many people utilized it.
Yeah.
But theirs had so many variables that it didn't make sense.
How that program works because there were so many obstacles and variables and whatnot.
Yeah.
But these guys, I mean, I laugh at their website because they've dumbified everything to make it so quote unquote like user friendly.
Well, I don't know what you mean by laugh at it, but I think it's actually like a phenomenal business. Like from a business perspective, these guys are brilliant.
Fucking right.
Not only are they cashing in on the equity from your home, which in 10 years is highly probable. They also say, but don't worry, we'll absorb the loss with you as well. Right. Which is, in 10 years is very unlikely. But they also, you have to use their lender. So they're also, in the short term, they're also getting compensated with referral fees.
Big asterisk.
Yes.
You got to use our lender.
So I'm sure they're getting compensated.
Well, that was another question that I would have had for lenders, because how would you approach a bank, as an example, and going through the approval process with the bank? They want to know where the down payment is coming from.
Right.
Oh, yeah, well, I've got 5% and the other 15% is going on title for this company. Oh.
Well, I don't think it would be a problem. I mean, they just need to know where the money's coming from. That's common. Like, could be a gift from a family member, whatever it may be. It doesn't affect them.
Yeah, but as a lender, how do you feel about... I wonder...
They're not on title.
They're not. No. So it's just a contractual obligation.
Yeah.
Interesting.
Yeah, so on their website, because there's...
Well, there would be no way for them to be on title. At least I don't think
You maybe
so.
put a lien on it.
Maybe.
That would be a way to do it. But I think
Yeah.
I'm sure they just do it with a contract.
Right.
But yeah, so under the FAQs, it says, do I have to use a specific mortgage lender? And it just says, yes, period. And then it goes on to elaborate.
And it doesn't say who that lender is.
It does. It's Equitable Bank. Is it
Equitable?
Does that sound
Okay.
right? Yeah.
So it's a reputable lender.
Yeah.
Typically one that does charge higher interest rates.
Well, that's one factor. And, one would assume that maybe people utilizing this system are more likely to be approved through that type of lender. Not always the case. You could have somebody with excellent credit, but they just haven't been able to manage to establish.
So now it's an uninsured mortgage.
Correct.
Going through, I don't know if I guess Equitable would be considered a B lender mortgage. So your rate is a little bit higher. I know for a fact, because I had some family members that had mortgages with Equitable. When you want to break those mortgages, there are significant penalties and administrative fees and all that. So you'd have to be very diligent on checking the contract that you're signing, both with this company or any other similar co-ownership companies, because I'm sure they have competitors in the marketplace, and probably will have more going forward. But you definitely would want to make sure that you know exactly what you're signing when it comes to that mortgage.
Yes.
Any prepayment options? What are the costs for breaking that mortgage?
Yeah, well, I mean, a lot of people in this situation maybe just don't have the choice anyway. So it's kind of like reading the terms in, when you get a new iPhone. It's like, yes, I accept, or no, okay, well, I just have to get rid of the iPhone.
Or when you download an app that tracks absolutely everything.
You either use it or don't use it. If you don't agree, you don't get to use it. So as much as it's good to know that stuff, because maybe that influences what you do.
Here's the thing.
If you're doing this,
everybody's
you have no
talking
choice.
about homes being unaffordable. And how would I ever save that much money to come up with the down payment? Well, there's an option.
Yeah, but I would still say,
well, you either own a home or you don't.
Well, one thing that's interesting here is can Ourboro force me to sell my home? And they say they cannot force you to sell unless you were in gross violation of their terms and conditions outlined in our co-ownership agreement. I was trying to find a copy of this. I could not find it.
Well, maybe we'll email them and see if they'll send us
If we can
one.
get our hands on that, that would be interesting to know. What are the terms? I would think they're pretty basic. I would think they're more just you can't destroy the house because it's their asset that you need to be maintaining properly.
How do they monitor that?
It's a good question. Maybe the co-ownership agreement will explain that. Maybe they do annual visits like you would as a landlord.
Does it say if it has to be your primary residence?
It has to be your primary residence.
Right.
You can rent out a portion of it and you can keep 100% of those proceeds, but it has to be a primary residence.
Right.
So,
well, for somebody that really wants to get into real estate, foot in the door, where I see this being as a viable option is obviously, well, it could be anybody of any age or new immigrants or what have you. But there's a lot of people that, they're making $50,000 a year and they have a spouse making $50,000 a year and they have $100,000 family income and they have that 5% down. Go and buy something now where in the future, maybe you finish the basement and rent that out. Maybe you build the separate dwelling like we talked about, what was it called?
Laneway home, coach house.
Coach house, laneway home, whatever you want to call it. And now you have two sources of income. My only thought process with that is then this fucking company owns 75% of the equity that you're working hard to build.
So I would say the best strategy, I think the better option would be you take the down payment that you do have and you buy, we've talked about this, you buy something further away that you can afford to purchase on your own so that you get to benefit from 100% ownership, 100% equity.
Yep.
And then 5 years down the road, you sell that and use those funds to buy 100% ownership of the house in your community.
Shithole up in Elliott Lake. You spend a week there painting it, fixing it up, and you rent it out forever.
Yeah.
Yeah.
And just rent the house in a neighborhood you want to live or have to live because of whatever, work, family, friends, whatever. Or if you do this option, I would say you should start busting your butt. The moment you get that house, start saving up as much money as you can to get out of that agreement as quickly as you can.
Yeah.
And wait for a dip in the market. That's another thing that'll be interesting because you can buy them out at any time based on a valuation of fair market value at the time. But I'm sure there's stipulations about that.
Wait till the dip, buy them out.
Right.
Wait until it comes back
up. Like if someone bought
sell it
in January, February of last year,
right,
and then had a valuation done today, there would be a loss. And I can't imagine you'd be allowed to buy them out at that point. Because, you wouldn't be buying them out. You'd be letting them out of the agreement.
Yeah.
But, so that would be interesting to know. Like, there must be a minimum amount of money they'd be entitled to, even if there's a loss, if you're buying
I
it
would
out.
tend to believe that whatever agreement is provided to you to sign in this situation of you purchasing a home and using their funds to co-own, there are going to be a lot of, let's just say, lawyer cross-referenced line items, asterisks, that protect them and not you.
Right.
So, just understand what you're signing, I guess. But it's an option, right? Like I like the fact that it's a forward-thinking company. It's a Canadian company, and it's providing options. I think there will be, and don't forget, like we're in a real estate market that is considered one of the best global real estate investments, right?
Most stable for sure.
So as a newcomer to this country, where your dream might be to own Canadian real estate, the fact that you can buy something for your family and actually make money on it. You're still making money. You're still getting equity out of this.
You hope.
You hope.
Yeah.
And in 10 years, the likeliness is, and you look over history in Canadian real estate, it's not a matter of if you will make money, it's a matter of when.
Well, I would think with this, again, I think it's a very smart business idea. I think it's brilliant. And if they do well, they're going to do very well because they're getting referral fees from mortgages in the beginning and they're cashing in huge later on.
There must be a company like this in the U.S.
I'm sure this is not the first time this has been done. And even, like we said, the government had a similar program.
I just wonder, are Canadians, because Canadians are very conservative when it comes to alternative lending methods, which is what's kept our banks so strong.
Well, conservative, you're talking about end users?
Just so being more conservative on maybe this is changing now too, spending and credit. Canadians are typically more conservative than Americans, as an example.
Okay.
The banks are more conservative with their lending patterns and habits.
In terms of having more strict requirements to approve people for various credit.
For sure. And then, the mass population of Canada that would be able to qualify for loans and mortgages are just generally more skeptical of these type of arrangements.
Mm-hmm.
So I'd be curious to see, who these applicants might be who would benefit from, not benefit, because we know who would benefit, but who would actually go through with something like this?
I think the three options that exist, I mean, one, maybe four, I suppose. One is just finding creative ways to get the down payment, whether that's through family or whatever, getting early inheritance, stuff like that. Option two, which I would say is the best option outside of that first option, is to buy further away, somewhere you can afford without needing assistance.
100%.
Rent it out, become a landlord, and then rent the house you live in. The other option is this
and
one.
what you're not, sorry, before you go on to that, using that model of buying where you can afford and becoming a landlord.
Right.
Let's not forget the fact that your income is probably going to increase over time, especially if you're younger. Maybe you get promoted. Maybe you get a pay increase. Maybe you go to a new company that will pay you more, whatever. The home is appreciating in value and you're paying down your mortgage. So is there potential in a few years for you to refinance that property and then purchase a second property, whether it's another investment property or your primary residence?
Right. Yeah.
So that to me would be the best option. But yes, option number 3
is this one, Ourboro, or a similar company, if others exist, which is, I would say, is my least favorable option. What I would do before this, which I would never recommend before, but when compared to this, I think it's a better option, is rent to own. Because rent to own, although
you don't see a lot of rent to own options.
You don't, but there are companies that specialize in it. Rent to own, you still, when you own it, you own 100% of it.
The other option is to go to Frankie with the briefcase that says, oh, you need $100,000? You pay me 12% and it's yours.
I wouldn't recommend going to Frankie. You'll either end up dead or in the same situation as Ourboro.
Well, it's still an option. There are people.
Yeah. I have lots of clients right now who have sold their properties. Yes. They're renting. They've cashed in on the equity. They're doing private mortgages at 10 to 15% they're making. So, but there's risk associated with that on both ends of the spectrum.
Listen, there's risk anytime you get into these kind of alternative methods.
Right.
You just have to try and mitigate your risk where it's a smart decision for you.
Yeah. So to sum it up, I would say if you're using this option, try to get out of it as quickly as possible so that you can cash in on the long-term equity of the home, appreciating, not them.
If you're buying them out, that's what you're saying.
Well, I'm saying buy them out.
Right.
Like just figure it out. Like eat macaroni and tuna for the next 5 years in order to save up enough to buy them out at whatever the valuation is at that time, even if it means, carrying a mortgage.
How do you know the recipe for my tuna casserole?
Oh, I'm sure it'd be fantastic, Mr. Open House Chef.
So it's one option now that's available. Ourboro, Ourboro. Check it out. Let us know if you have any experience with this company or any similar companies.
Or just your thoughts on the concept of it, because it's relatively new.
Yeah. Would love to hear what people think. So, till next time, my friend.
Ciao. There you have it. Thanks for watching episode 238. Hopefully you enjoyed this episode and learned something about this new concept. And we'd love to hear your feedback on the idea. Make sure you subscribe so you don't miss out on episode 239.